has declined to extend several key CARES Act lending programs that were funding emergency lending programs over at the Federal Reserve. They include the Main Street lending facility, the corporate bond purchases, as well as the municipal bond purchases. Those were the three key ones where most of the lending took place. The Federal Reserve, Fed Chair Jay Powell had made pretty clear in no uncertain terms that he wanted these programs extended beyond their expiration of December 31st. And Mnuchin saying no, he wants this money back. He has specifically requested that the Federal Reserve now send back some $420 billion that was available to the Fed for lending. Could have been trillions, but it didn't end up being very much. It was the very existence of the programs. Well, we, of course, first brought you this story about the split between Mnuchin and Powell on this issue earlier this week, and now a decision has been made in which Powell and Mnuchin, who have, I guess, worked pretty well together throughout most of this crisis, now going their separate ways on the issue of extending these emergency lending programs.
Steve, why? Why would the Treasury want to pull these important lifelines or potential lifelines as the virus crisis is getting worse? And while the economic crisis has gotten a lot better, is far from over, we still have millions of Americans unemployed and many small businesses and municipalities suffering.
So my understanding is that they believe that the markets have restored themselves, that the markets are trading well, especially the corporate bond market. I don't know what the rationale is on the Main Street lending facility, which is just now ramping up. And certainly you could make an argument many Main Street or mid-sized businesses, which are the target of these, need these funds. So that's unclear. On the muni market, it seems to be trading okay. On the other hand, you could argue there's a political reason, which is by giving this money back before a Biden administration takes over, it would deny them access to these funds and lending. Future lending would have to come from a much smaller pot of money, which is a $10 billion exchange stabilization fund that I know you know about, Sarah. That would be a much smaller pot of money that would leverage up to much less lending than otherwise would be available.
Shepard Smith here. Thanks for watching CNBC on YouTube.